I just found out how Warren Buffett turned $13 billion into $38 billion, while everyone else was panicking about Japan falling apart. And the way he did it should scare every single American investor watching this right now. Before I break this down, hit that subscribe button because I cover moves like this every single week, and you do not want to miss the next one. Drop a comment right now and tell me one word: Buffett or Japan, just so I know you're actually paying attention, because what I'm about to show you gets wild fast. And stay till the end, because the last part of this story is the part almost nobody understands, and it changes how you should think about every collapsing market you've ever been afraid of. Let's start with the headlines because they sound terrifying. Japan's government bond market is in the middle of its worst sell-off in 3 decades. Yields on Japan's 40-year government bonds have pushed past 4%, a level that has not been touched for that maturity in 30 years. The yen has been sliding hard against the dollar, and inflation pressure has been building inside an economy that spent decades fighting the exact opposite problem: deflation. Japan's new leadership has been pushing fiscal stimulus and tax cuts, and investors have responded by dumping long-term Japanese debt in a way that looks, on the surface, like panic. If you only read the headlines, you would think Japan is falling apart. But here's what almost nobody is talking about. While Japanese bonds were getting hammered, and while the yen was sliding, Warren Buffett was sitting on one of the best trades of his entire career, and it was happening in that exact same country. Let me give you the numbers, because they are almost hard to believe. Back in 2019, Berkshire Hathaway quietly started buying stakes in 5 Japanese companies that most Americans have never heard of. These companies are called the Sogo Shosha, Japan's giant trading houses. The 5 names are Mitsubishi Corporation, Mitsui & Company, Itochu Corporation, Marubeni Corporation, and Sumitomo Corporation. These are not household brands like Toyota or Sony. They are massive, diversified conglomerates that touch nearly everything: energy, metals, food supply chains, logistics, commodities, finance, in a structure that actually mirrors Berkshire Hathaway's own business model. On August 30th, 2020, which happened to be his 90th birthday, Buffett publicly revealed that Berkshire had built roughly 5% stakes in each of these 5 companies. At that time, the combined value of those 5 positions was about $6.3 billion. Most people barely noticed. Japan, at the time, was seen as a stagnant, aging economy that global investors had been avoiding for years. But Buffett kept buying. By the end of 2024, Berkshire's total cost basis across all 5 trading houses had grown to $13.8 billion. And the market value of that stake had already climbed to $23.5 billion. That alone would be an incredible return, but it gets more extreme. As Japan's bond market chaos intensified, and as the yen kept sliding, those same 5 trading house stocks kept climbing. By recent estimates, that $13.8 billion cost basis is now worth somewhere around $38 billion. Do the math on that for a second. That is a paper gain of roughly $24 billion. $24 billion from an investment most financial commentators dismissed as boring 5 years ago. Let that sink in for a moment, because this is the part that should reframe how you think about collapse headlines forever. The very same forces that were being reported as a crisis, a bond sell-off, a weakening currency, rising inflation, were the exact forces fueling Buffett's returns. Here's why that is not a coincidence. When a currency weakens and inflation rises, companies that deal in hard physical assets, energy, metals, raw materials, global commodities, often become more valuable, not less. The Sogo Shosha are exactly that kind of business. They are not fragile tech startups or over-leveraged banks. They are diversified giants that profit from global trade flows, commodity pricing, and supply chain control. The kind of business that tends to hold up and sometimes even thrive when a currency is under pressure. So while retail headlines were screaming about a Japanese debt crisis, the actual companies Buffett owned were riding a very different wave. Now here's a rehook for you, because this next part is where it gets even more interesting. Buffett didn't just buy stocks and hope for the best. He financed a huge portion of these purchases using yen-denominated bonds. Berkshire issued debt in Japanese yen to fund the stock purchases, which meant Berkshire was borrowing in the same currency that was under pressure. Here's why that detail is genius, not risky. When the US dollar strengthened against the yen, the value of Berkshire's yen-denominated debt effectively shrank in dollar terms. Berkshire has reported billions of dollars in after-tax gains directly from those yen bonds, including hundreds of millions in a single recent year alone. So Buffett was not just profiting from the stock appreciation. He was also profiting from the currency mechanics on the debt side of the trade. That is a two-sided win most investors never even think to structure. Stand back for a second and look at the full picture. Buy undervalued cash-generating companies in a currency everyone is afraid of. Finance the purchase using debt in that same currency. Now let the currency weaken. Watch both sides of the trade, the stock value and the debt discount, work in your favor at the same time. That is not luck. That is one of the most disciplined examples of currency-aware value investing in modern financial history. And Buffett has said publicly that the returns from this trade have been even better than he originally expected back in 2020. Now let's talk about income, because this is the part almost nobody brings up. The 5 trading houses currently pay dividend yields somewhere in the range of roughly 2 to 3.4%. Compare that to some of the biggest American tech names. Some major U.S. technology companies pay dividend yields under 0.5%. Berkshire Hathaway itself pays no dividend at all to its own shareholders. So this Japan position is not just a growth story. It is also generating real, ongoing cash income for Berkshire, estimated in the hundreds of millions of dollars annually. Here's your rehook, because I want you to really process this next fact. Berkshire didn't stop buying after the stock price exploded. Regulatory filings show Berkshire has continued raising its stakes year after year, from around 5% in 2020, past 6% in 2022, past 9% by 2025, and crossing the symbolic 10% ownership threshold in all 5 companies by 2026. Originally, Berkshire had agreed to a self-imposed cap of staying under 10% ownership in each company. But the 5 trading houses agreed to loosen that restriction, clearing the way for Buffett's team to keep buying even more. Think about what that tells you. If this were a short-term trade or a lucky bet that had already played out, the smart move would be to take profits and walk away. Instead, Berkshire has been doing the opposite, increasing exposure, deepening the position, and treating this as a long-term core holding rather than a quick win. Buffett has always said his favorite holding period is forever. This Japan position is starting to look like exactly that kind of commitment. Now let's connect this back to something every American watching this needs to understand. Markets do not move in a straight line, and headlines about collapse are often describing short-term volatility, not the actual underlying value of well-run businesses. Japan's bond market genuinely is under real stress right now, and that stress is real and worth watching closely. But a bond market sell-off and a currency slide do not automatically mean every asset in that country is collapsing in value. In fact, in this specific case, the opposite has been true for the businesses Buffett chose. This is a lesson in reading past the headline and asking a deeper question. Who actually benefits when a currency weakens, and who actually gets hurt? Bondholders holding fixed-yield Japanese debt from years ago are getting hurt by rising yields. But diversified, commodity-linked, globally exposed conglomerates like these 5 trading houses have a very different risk profile entirely. Here's another rehook, because I want you thinking about this the next time you see a scary market headline about any country. The Nikkei, Japan's major stock index, has climbed roughly 33% over a recent 6-month stretch, while the S&P 500 gained around 8% over that same window. That is not the performance of a stock market that is collapsing. That is the performance of a market going through a currency and bond adjustment, while equities, particularly export and commodity-linked equities, are actually being rewarded. This is exactly the kind of disconnect Buffett has built a career on exploiting. Buy quality assets when fear is loud and headlines are scary, hold with patience, and let time and structure do the rest. Now, why should any of this matter to you, sitting in the United States, watching this video? Because the exact same pattern plays out in American markets constantly. Every time you see a scary headline about inflation, a currency, interest rates, or a collapsing sector, ask yourself the question institutional investors are already asking: who structurally benefits from this specific kind of stress, and who gets hurt? That single question is the difference between panic selling at the bottom and quietly building a position the way Berkshire did. Buffett didn't predict a Japanese bond crisis back in 2019. He simply bought quality, cash-generating businesses at a fair price, structured the financing intelligently, and let the position compound for years, regardless of what the headlines said along the way. That is not a flashy strategy, and it is definitely not exciting content for most financial media. But a $24 billion unrealized gain, on top of hundreds of millions of dollars a year in dividend income, is the kind of outcome that speaks for itself. So here is the real takeaway I want you to leave with today. Collapse headlines and opportunity are not opposites. Sometimes they are the exact same event, just viewed from 2 completely different angles. Warren Buffett looked at Japan when nobody wanted it, structured a smart, currency-aware position, and is now sitting on one of the most quietly brilliant trades of the last decade. If you found this valuable, make sure you're subscribed, because I break down moves like this and the ones hiding behind scary headlines every single week. Drop a comment below and tell me which part shocked you the most: the $24 billion gain, the yen bond strategy, or the fact that Buffett is still buying, even now. Share this with someone who needs to understand that market headlines and market reality are not always the same thing. Thank you for watching all the way to the end. Hit subscribe if you haven't already, and I will see you in the next one.